Hello, good morning. Thank you so much for the invitation to speak here on behalf of Global Intelligence. I've got about 10 minutes, I think, to speak about the global metals market trends. So if you want to get the slides or more numbers, feel free to contact me later. At Global Intelligence, we don't provide price forecasts or any recommendation, no holds buy or sell. So just briefly, I will try to speak a bit on China. I think most of it was spoken by Max at the S&P, especially on the One Belt One Road. And then on metals and industry. On China. Now, why are we always talking about China, especially the last few years? Now, the thing about China is that it has been the driving force for the metals demand. We all know that. It's the world's largest consumer for most of the commodities, for your base metals, for your iron ore. But the thing is that the country is also the single largest risk to earnings for the mining industry. Now, this stems as much from the quantity supplied by domestic producers as from the level of demand from China. Now, in the past 20 years, producers inside and outside of China have increased output volumes to meet rising domestic growth in demand. The country's slowing economy is likely to curb demand and imports for some of these metals, while China's export could gain on a weaker yuan, resulting in further surpluses. Now, here is just an overview on the precious metals. I thought it's good to start on looking at how Chinese share of gold demand compares to your platinum, your silver, and your palladium demand. Now, they're around about 30% share, and gold has the largest share. On the base metals, now the Chinese base metal demand is very significant. It will be for several years to come. Now, this is likely to mean that the world financial markets will continue to be exposed to the Chinese metals consumption and its transition to a consumer-led economy. When we did this analysis, the Chinese refined copper demand to March was almost 3 times that of Europe, twice of Asia, excluding China and India, and 6 times of the United States. The country's consumption is 24 times of Africa. But the scale of the Chinese future supply remains a wild card for the metals and mining industry, and that's why we care. The country's share of global production for commodities, such as primary aluminium and zinc, continue to climb. The China's share of global primary aluminium output reached 56% of this year to March, compared to just 11% in fiscal 2000, while it doubled for refined zinc to 44%. Now, the miners remain upbeat, for example, on the zinc fundamentals, because for zinc, the metal grades mined in China are very low, following depletion of most of its best reserves. Now we move on to metals. Now, we believe that new technologies, including the advent of electrical vehicles, could continue to support metal prices, especially for copper, nickel, lithium, and cobalt. Now, the metal industry has enjoyed a bull market since almost second half of last year as a result of higher than expected demand and economic growth in China, which helped to tighten the metals market surpluses. Now, precious metals, including gold, were sought by investors as an antidote to ongoing sagas like your Brexit and your Trumponomics. At Global Intelligence, we expect metals demand, including nickel, copper, aluminium, zinc, lithium, and cobalt, to peak in the medium to long term if the new technology revolution plays out. And this is what we mean here. Now, the metals consumption will continue to rise. And here we're looking at the metals demand for electrical vehicles, for aluminium, copper, nickel, and zinc. Now, we want to point out that the metals use will raise demand growth for the years to come. And here it's for up to 2040. so it could even result in a long-term peak. Now, China, the #1 buyer of metals globally, still lacks mineral resources on limited concentrate supply, particularly copper, nickel, and cobalt. Now, Chinese import may increase as their recycling supply is also boosted, and local companies are enticed to secure resources through overseas deals and investments. Now, the risk to this technology metal story includes technology failure, mass market lack of interest, low product sales, unfavorable legislation, policy changes, and substitutions. Now, China still targets a 60% urbanization rate in their 13th five-year plan, compared to 2016's of 57%. But we believe the metals demand growth rate is likely to slow. Here's just an overview. It's probably too small to see. At Bloomberg Intelligence, we have the S&D's copper supply up to 2050 here. Now, as we mentioned, the copper demand may raise on electronics, electrical engineering, and automotive industry with the help of this new technology development. Almost 65% of metal is used to generate and conduct electricity, including alternative energy sources. New demand may improve its dynamics in the short to medium term. Now, while the existing copper miners face declining rates, new mining projects remain lower. New mining projects is still lower, and in the long term, probably higher scrap volumes may support supply. Now, Bloomberg Intelligence estimates annual global demand for copper may rise 94% in 2050 compared to 23.5 million tons in 2016, based on WBMS data. For nickel, we also believe that demand could soar, especially on batteries. However, stainless steel demand will still dominate. Demand from the global penetration of electrical vehicle market could give substantial amount of nickel being used in the batteries segment. This includes the NCA batteries with a cathode comprised of cobalt, lithium, nickel, and aluminum oxide. Now, the further incremental consumption for nickel is contingent on the success of global electrical vehicles. Your price acceleration, substitutions for nickel in the battery and stainless steel industries, regulation or policy changes impacts could have effect on future demand. Now, on zinc, just quickly on zinc, the zinc market fundamentals have been very strong, and this has been led by higher Chinese demand, your low stock, and also your positive sentiment following the earlier mine closures by companies including Glencore, Vedanta Resources, and MMG Limited. Any further improvement in automotive market, real estate, and infrastructure spending in China and in the United States could boost demand for the metal. Now, zinc price have increased 25% year to date to over $3,200 a metric ton, after a 65% rise in 2016, as Chinese mine supply fell in the second quarter compared to a year before. However, these tight market conditions, especially for zinc concentrate, could reverse in 2018 to 2020 and pressure prices. New zinc mine supply could likely come from projects, including your MMG's Dugald River and Vedanta's Resources Gamsberg, which may offset the Scorpion mine closure. Now, further zinc price increase could also entice Chinese supply growth to come back. On iron ore, I wouldn't repeat it. We have a similar view with MINEX, where quality is key for China and steel makers. Well, we've seen that the Chinese have been purchasing high quality of ore, particularly from Australia and Brazil, and would likely to continue to rely on these imports, given its sources quality feed for the local steel production. However, the iron ore prices may be challenged by China's winter curtailment policy, which starts from mid this month to mid-March next year, which ends mid-March next year, which seeks to cut 50% of steel output by major producing steel cities, offsetting potential ex-China growth such as India. Now, the iron ore price had a good run earlier this year, and that was driven by heavy Chinese iron ore restocking on better than expected Q1 economic growth, imports brought forward by the Chinese, and speculative stockpiling due to the environmental curve. On gold, I thought this chart with the metrics could probably best summarize the opportunity and challenges when you're looking at the gold market. This is one of the analysis we do quite in-depth at Bloomberg Intelligence. Now, to understand the gold price, we have 8 factors that we've seen and tested since 2007, which shows that you really need 8 of these key ingredients to have seen the gold price where it was over almost $2,000 an ounce back in 2011. You can come later to see me for the in-depth research on this. What we see is that these 8 elements have driven the gold price momentum from 2007 to 2016. And we see from here we can see it's the use of the global exchange traded funds as a refuge in times of global financial and geopolitical crisis. You need your dollar weakness and inflation and low or negative interest rates. Also on the list is increasing demand from China and India, weak confidence in financial markets, greater global gold consumption, and higher net central bank purchases. When you meet all these 8 criteria, we have seen historically in the past that gold price rises. On uranium, I just thought I'd touch on this because there will be some esteemed speakers talking about Kazakhstan and some of the other Eurasian countries. Here on China, there has been major focus from the Chinese on uranium demand. And we think that it could increase as nuclear power plays a vital role in the country's long-term energy strategy, including reducing its carbon emission levels. The country has about 233 nuclear reactors aimed for by 2030, compared to about 35 currently, based on the world nuclear data. Cobalt. Cobalt is a metal that has been the star of this year, and since last year. Now at Bloomberg Intelligence, we think that the world's thirst for clean, green energy, associated technologies, especially for batteries and electrical vehicles, may drive cobalt demand to a peak. China's increasing defense budget and proposal for higher US spending under President Trump may also boost consumption of superalloys for military needs. The metal is listed as a critical raw material by the European Commission this year. Now, any supply disruption from the Democratic Republic of Congo, the metal's largest mine source, may buoy prices. The dollar is one to watch for, and as we agree with Max, what we see at Bloomberg Intelligence is that historically, dollar-denominated prices of metals, including copper, zinc, nickel, gold, and aluminium, tend to strengthen when the greenback weakens. But here's the thing, the Federal Reserve's monetary tightening and further interest rate hikes in Q4 and 2018, plus the intention to reduce asset accumulation under the quantitative easing policy, may result in dollar appreciation. This may in turn dent metals' performance. I'll just summarize on the mining industry. It's such a huge industry, so I'll just pick a few where it may be of interest to some of you. Now, on the precious metal side, I've used these metals to show that mine production is really the key of supply. At Bloomberg Intelligence, we have done study on the world's 20 top producers. And what we've seen is that for the production to 2019, production could fall. And it is expected to fall to its lowest in 10 years, based on analysts' estimates. Now, the weighted average gold reserve grades from these leading producers has also been falling, and further decrease of the reserve grades could actually impact lower future gold gold production. Now, on the cost side, now the gold miners have done a really good job to aggressively reduce their costs. And here is a chart of what we do in Bloomberg Intelligence, we track the all-in sustaining cash costs. And also here there's a graph on the cash margin. Now we've seen that the cost line has been decreasing. But the problem is that the key for the gold miners is really gold price. Now the miners' costs could rise if the gold price is sustainable, and this may be true for some of the metals. However, we've seen, like, for example, in aluminium, now the raw materials cost pressure is rising. We have seen higher costs from your alumina, bauxite, your caustic soda, and we believe in Bloomberg Intelligence that this could actually support higher prices. On capital expenditure, we've done the study on the top leading copper miners, and we've seen that for new supply growth, it has been very slow. There are fewer major green projects that will start before 2020, such as your Freeport's Cobra Banana and your Codelco's Chuquicamata underground. Now the miners probably will stay cautious and limit spending to reflect uncertainty in the demand outlook for copper and focus on balance sheet. Now the capital expenditure here shows that for 2017 level will fall down by 61% when we compare to 2012. Any further potential price weakness could probably affect the miners' capital expenditure. So this is just a summary of what we have spoke for. I mean, it's quite a wide topic, and these are the three things that I've dealt. If you need any more information or numbers or research, please come and find me. Just to wrap up, what is Bloomberg Intelligence? Bloomberg Intelligence, we at Bloomberg provide an in-depth analysis. We cover the mining companies and also the metals industry. And we also have research on credit and litigation. Thank you.